Now let me look at a basic high-level overview of a fixed income security. So as the word itself is saying, there is a fixed income that is largely associated with it. In general, the most common variant of fixed income securities is a bond, where as a characteristic of the bond we see a series of interest payments at regular intervals of time. A predefined fixed amount is typically paid. In general, it is fixed, though there could be a variation, and there is a principal repayment on a maturity date. A maturity date also is known in advance, and that is the principal is repaid on that particular maturity date. That's a broad characteristic of a bond, and we see that some of these bonds are tradable in the market. And what we typically see is, depending on how the interest rates in the market are changing, the tradable values of this particular bond also change accordingly. And generally, the different kinds of bonds, they are associated with different credit ratings. So what we typically are talking of is every bond has a unique set of characteristics, whether it is with respect to the way they are doing the payments, whether it is with respect to the credit ratings associated, and the kind of tradability that is associated. We can talk about wide varieties of features that are typically associated with a bond. While in simplistic sense, a bond is an instrument which typically makes a series of interest payments at regular intervals of time, and a principal repayment on maturity. What we see is lots of variants can come into it, and that is what we spend time now in terms of understanding what this fixed income security is all about. What are the key differentiators or key features that are associated with this fixed income security, right? So a few things to focus on. First, we will look at who has issued the bond. Typically, the issuer of the bond. In general case, the issuer of the bond is that particular entity who is borrowing, right? The borrower, the issuer. Otherwise, from a bond terminology, whatever is called as an issuer, in reality is actually doing the borrowing money. So it could be done either by the various corporations, the companies, both financial as well as non-financial kind of companies can get into this borrowing part. Or in some cases, we see that the governments get into the borrowing. Again, within that government, we can talk about the national government doing the borrowing, or it could be the state kind of governments which could do the borrowing, or in some cases municipalities can do a borrowing for various social welfare activities, or any other quasi government bodies, right? Some government agencies where government is not having a direct obligation to repay. Whereas in all these things, okay, here the national government is obligated to pay. Typically, we call them as sovereign bonds. Here, the state government is having an obligation to pay. Here, the municipality government is having an obligation to pay. But here, it's a government entity, or quasi-government, semi-government kind of a body will issue the bond. So, government does not have a direct obligation with respect to the payment. So these kind of things could be there, but there could be a few borrowings which are supranational entities, which is much beyond the government. Probably those kind of organizations which are operating in multiple countries, multinational kind of setups, and generally we categorize IMF, World Bank, these kind of entities under the supranational kind of entities. So even they can get into the borrowing. So what we typically see is different issuers can operate in the bond market, right from the corporations which want to borrow money for executing their business, to governments which want money for implementing various welfare activities, to the supranational entities like IMFs and World Banks borrowing again for the implementation of their different projects. So every bond is characterized first by the issuer. Then another differentiator with respect to the bonds is the maturity. So in some cases we can have a maturity of 1 day, right? This is the date on which the principal repayment will happen. Remember that. Whenever I am talking about the maturity period, we can interpret it as the date on which the principal repayment happens. And what we can look at is it could be anywhere like 1 day, or even it can go up to 30 years. So there are different maturities that are present. And as a word, the maturity, we also hear the words like term to maturity or time to maturity, or we even talk about the word tenure of the bond. So the bond is still the bond is going to mature in this many years of time. So there are bonds with very low maturity periods, and there are bonds with very high maturity periods. Of course, there are a few bonds even which are issued for 100 years as well. And in some cases, there is no maturity date also. And wherever there is no maturity date, we call those kind of bonds as perpetual bonds. And what we see for those perpetual bonds is only the interest keeps getting paid at regular intervals, but there is no commitment on the principal repayment date. And as a classification, any kind of maturity which is less than 1 year, we call those kind of bonds or securities as money market securities. But wherever we see that the maturity period is greater than 1 year, I will classify them as the capital market securities. So that's one more important dimension and classification that is associated with the maturity of the bond. Then another dimension or another important term that we need to be comfortable with is the par value. Sometimes we call it as face value, or sometimes we call it as the principal amount to be repaid, or sometimes it's even called as maturity value, right? On maturity, what is the amount that is getting paid, or even redemption value. When the bond is getting redeemed, what is the amount that is typically getting paid? But all these mean the same. What is that particular amount that really gets paid when the bond is matured? On the date of the maturity, what is the amount that is typically getting paid? That is what is called as a par value. And what is very much important for us regarding the par value is any kind of a price at which I have to purchase the bond today, right? At which I want to purchase or sell the bond, it is always expressed as percentage of the par value. So if the par value is 1000, and let's say currently the bond is being sold at 1020, the way it is quoted in the market is it talks about 102. It is quoted as a percentage of the par value. So a percentage of the par value, typically 1020 divided by the par value of 1000, if I am expressing it in terms of percentage, it comes out as 102%. So any kind of price quotation regarding the bond is established as a percentage of par value. And what we typically see is any bond in the market, if it is being sold for more than the par value like this, greater than the par value if it is being sold, we call those kind of bonds as the bonds that are sold at a premium. If they are less than the par value, if they are sold at less than the par value, we say that these particular bonds are being sold at a discount. Otherwise, we say that they are being sold at par. So the par value is helpful from that particular perspective as well. It really is associated more and more with the pricing. Every bond that is being sold in the market, it is priced either at a premium or a discount or at the par value itself. Whereas the other dimension also where the par value helps is the coupons. Coupon typically as a definition is that particular amount that is paid on a regular basis. Whatever is that particular amount that is made as a series of regular payments to the investors, that is what we call as a coupon. And there is a coupon rate that is associated. Even that rate is established as the percentage of the par value itself, right? And that particular coupon is typically paid. If I say the coupon is 8% and par value is 1,000, it means that 80 dollars is typically being paid every year as a part of the regular payment. And if the bond is having a maturity period of 5 years, it means every year there is 80 that is getting paid, 8% of the par value, $80 that is getting paid every year until 5 years. So that is how the coupon gets linked. Even that is expressed as a percentage of the par value. And these coupons generally there could be paid on an annual basis or probably any other frequency. It could be paid on a semi-annual basis. Now if they are paid on a semi-annual, the same coupon would be paid as 40 and 40. 40 would be paid now after 6 months and the remaining 40 after 1 year. The same way we can talk about quarterly, which means in 4 quarters 2020 is being paid. So expression wise the coupon is always expressed in as a percentage of the par value, and that too the annual payment that would be paid, but the frequency of it decides at what time period how much is typically being paid. So coupons is one more important aspect with respect to the bond. And if this coupon is generally fixed, right, if it doesn't change every year and it is fixed, we call those kind of bonds generally as conventional bonds, or sometimes people call them as plain vanilla bonds. So that's one more important concept that needs to be comfortable with. And some bonds, again, the difference is some bonds keep paying a regular coupon like this, whereas some bonds say there is no coupon payment at all. Only the par value is paid on maturity. No intermediate payments until the maturity. So if I am talking about a 5-year maturity period, there is nothing that is paid at the end of 1 year, 2 years, 3 years, 4 years. Only the par value is being paid at the end of 5 years. Those kind of bonds which don't pay any kind of coupons, any kind of regular annual payment, they are classified as zero coupon bonds. The word as it is clear, they don't pay any coupon, and that's where they are called as zero coupon bonds. And and if they are not paying anything in the middle, obviously the price at which they have to be sold is much less than the par value, right? Because the par value, let's say, is 1,000, they have to be sold at much lesser than 1,000 today because they don't make any intermediate payment. So we'll say that those kind of bonds are always being sold at a discount. And we also use the word they are pure discounted bond, because at any cost they are needed to be sold at a discount itself. They can't be sold at a premium at all, because they are not paying any intermediate payments. Later we'll try to see if a bond that is paying the intermediate payments, depending on how much it is paying in the middle, it would be either sold at a discount to the par value or at a premium to the par value. So this is one more concept that we need to be comfortable with. And another important concept or a differentiator with respect to the bonds is the currency denomination of the bond. In general, we see that the bonds are issued in the local currency itself, means the payment of the interest as well as the principals that is done in the local currency itself. But there are a few bonds where the coupon payment and the principal repayment, they may not be in the same domestic currency, especially for companies where the currency is very volatile, especially for the companies where the currency is very much fluctuating. Investors may not invest in that kind of countries whose currency is fluctuating heavily. So these companies can resort to issuing the bond in a particular currency which much stable, and because of that stability it can attract more and more investors. So whenever a company in country X is issuing the bonds in country Y, we are talking about the currency there. That is where the currency becomes an important aspect. There could be a dual currency, those kind of bonds have an impact of the currency on their valuation. So there could be a dual currency bond where coupon can be paid in one currency and the principal repayment can happen in another. Or we can talk about bonds like currency option bond. So as the word itself is saying, the investor will have an option in terms of deciding in which currency he wants his coupon, he wants its principal. So in a simple way, what we really need to understand is the currency in which the bond is issued also plays an important role in terms of the pricing, the valuation, and the risk that is associated with respect to the bond. So all these important features differentiate one bond from the other which are issued in the market. So though the definition is it's a fixed income security, all these differences can create thousands of different bonds floating in the market. So a good understanding of all these bonds, their differentiating elements, plays a very important role for any kind of an analyst. All right. Now let's look at the various legal, regulatory and tax aspects with respect to a fixed income security. And in this context, one of the most important topic that we need to cover is regarding the indenture that is associated with the bond, and also different kinds of bonds. What is the kind of legality related restrictions they carry? What are the regulatory prospects that they carry? And what are the taxability things with respect to the fixed income securities? So, just to get started, first thing I would like to look at is the indenture. And whenever I talk about an indenture, we are bringing up a legal contract that is between the borrowers and the lenders. And here, in case of bonds, we call it as between the issuers of the bond and the investors of the bond. The roles are more or less the same. The issuer plays the role of a borrowing and the lender plays the role of the bond investor or a bond holder plays the role of the lending. So whenever we talk about the indenture, a few things that go into it. One, the obligations. What is that this particular issuing company? What are the various obligations of this issuing company towards the investor? And it also talks about what are the restrictions, what are the do's and don'ts which are applicable to the issuing company. And those kind of do's and don'ts or restrictions are typically summarized in the form of covenants, right? These specify the do's and don'ts of the issuing company. And some of those covenants are more affirmative or positive covenants. So, which means the do's. What is that the issuing company needs to do during this, as long as this bond is active? And there are a few negative covenants as well. What is that the company should not do with respect during this bond issue period? And this particular indenture is the most important thing for any kind of future transactions that happen with respect to the company. So whenever I'm looking at affirmative covenants, they are something which the company should typically do. So something talks about the timely payment. The company should timely make the payment of interest as well as principal whenever it falls due. And what is the way it is protecting the various assets? The company should actually protect its assets even through insurance or any other mechanisms, and it has to abide by the laws and regulations of that particular country and any other legal and regulatory requirements. So these are the positive, but the negative ones are more like the restrictions. So a few important restrictions that can come out is selling those assets, which are typically kept as a collateral for this bond issue, or having the same asset for multiple types of bonds. Means probably let's say a land which the company owns has been kept as a collateral for issuing the bonds X. The same land is being kept as a collateral for issuing the bonds Y. This actually is typically a restriction. Probably if this particular piece of land has been kept as a collateral for issuing bonds X, it can't do the same for issuing bonds Y. That is what we call as a negative pledging of the collateral, because the collateral now doesn't have any more value because it has already been pledged for one kind of a bond. So if it is pledged again, it is called as a negative pledge, and the negative covenant associated in the indenture, they specify that the company can't typically do this, or any additional borrowing the company wants to do. Additional bonds, if it wants to issue, it has to go through the approval of the existing bond investors itself. Unless some financial conditions are met, the company can't directly go for additional borrowing. So all these things are typically mentioned as a part of the indenture document, and the company which is issuing the bond has to adhere to all these things. So the major intention is protection. All the bond holders, the major intention is the protection, because the company can typically take some kind of drastic actions. Now that the bondholders have lent to the company can typically get into drastic actions which can increase the probability of default. So all these things are typically to prevent the issuing company from taking those kind of drastic steps which can increase the probability of default, but at the same time they should not be too restrictive that even prevent a company from taking advantage of some kind of opportunities that come to them in the future, which can improve the profitability potential. So the indenture should deal with the positive and the negative covenants in such a way that they protect the interests of the bond investors, but at the same time provide the opportunity for the company to typically take an advantage of the various opportunities that come in the way and try to become more and more profitable during the process. So the indenture becomes one of the most important document with respect to the legal relationship that is existing between the issuer and the investor. Right now, we will look at the different types of bonds, especially from a legal and regulatory perspective. The different types of bonds. Sometimes we come across the domestic bonds. When I'm talking about a domestic bond, I'm purely talking about a US company. If I'm talking of United States as the domestic, a US company issuing bonds in US which are denominated in dollars. So we are talking of US incorporated firm, a registered firm in US, issuing bonds in the US and in the currency of the US, which is the dollar. These kind of bonds are called as domestic bonds. Whereas if I am talking about a foreign bond, with respect to US, I am talking about it, US being the domestic. If I say if a bond is issued by any other country other than US, let's say India, if a bond is issued by an Indian company, a company which is incorporated in India, and it is trading in the US bond market, and we are talking about trading in the US bond market in US dollars. So a bond that is issued by an Indian company trading in the US bond market in US dollars, those are typically called as the foreign bonds. Again, just there are a few different names associated with the foreign bonds. There is something called Yankee bond, typically any kind of bonds which are denote. These foreign bonds have different names depending on where they are traded and in what currency they are traded. So those kind of bonds which are issued by any company which is outside US and traded in the US market in dollars, we are calling them as Yankee bonds. The same logic, probably when I am talking about any company where any company which is trading its bonds in the Chinese market and issued in yuan, we are talking about them as panda bonds. So like this, we have different fancy names that are associated for foreign bond. Those bonds that are issued by a company which is incorporated outside a particular country, but the bonds being issued within the country and within the currency of that particular country, we are calling about them as the foreign bonds. Then the other dimension for these kinds of bonds, for the different types of bonds, are we have euro bonds. Here, in case of euro bonds, we are talking about any country any company in a particular country X. It has issued bonds in country Y, and the currency in this particular country is a different currency altogether. So basically it is like if a US company is issuing the bonds in country Y, probably either in dollars, not in the currency of Y, but in some other currency, we are calling them as the euro bonds. So these bonds are issued outside the country, not in the domestic, and that is denominated in a currency which is different from this particular country's currency. So a US company can issue a bond, let's say in Japan, denominated in dollars. Then it becomes a euro bond. The major intention is they are less regulated. The regulatory restrictions are much lesser. So just to take an advantage of this and bypass the regulations, these instruments are primarily created. So it can very well happen that a firm that is registered in India, incorporated in India, it is issuing a US denominated, US dollar denominated bond, but it is trading, let's say, in the outside the United States, right? Probably it is trading in Britain. These kind of bonds are typically called as euro bonds. So if they are traded across the world, the same euro bonds are typically getting classified as the global bonds. And generally the way we call those, the way we classify those bonds is the currency. So if a bond is denominated in US dollars and is trading outside the US, we call them as euro dollar bonds, or probably we call euro N bond in case the currency is in N but issued by any firm and it is traded outside Japanese market, we are calling them as euro N kind of bonds. So it is primarily designated based on the currency in which it is typically traded. And one more important aspect with these euro bonds is they are bearer bonds and they are not registered bonds. What is the difference between these two? When I talk about a registered bond, whosoever is the owner's name is actually available. The owner's name is available and it is registered. Whereas in case of a bearer bond, the owner's name is not registered. Whosoever owns the certificate, whosoever is owning the bond, whosoever has the physical copy of the bond, and whosoever presents the physical copy of the bond, he would be getting the benefit out of it. Just like currency, if I'm owning a $100 note with me, my name is not written on that $100 note, and I'm the owner of that. I'll get the benefit of that $100 as long as it is with me. I can give it to others and he becomes the owner of that $100 note. That is what is typically called as a bearer bond. So euro bonds are majorly the bearer bond. So typically they are more and more beneficial to someone who wants to avoid the taxes. So all these things typically need to be considered from a legal structure. What is the kind of a bond? Is it a domestic bond? Is it a foreign bond? Is it a euro bond? And basic understanding of these kind of bonds is required because the regulatory issues, the legal issues are different for each of these kinds of bonds, right? And apart from understanding the type of the bond, we are also talking about a few other important information that needs to be looked at while understanding the bond or while evaluating the bond. The entity which is issuing the bond. Who is issuing the bond? We'll talk about that. What is the details of the issuer of the bond? So that's one thing we need to understand. Any kind of collaterals that are there which are packaged with the issue of the bond, we need to understand that. We need to explore that in depth, and also we talk about any kinds of enhancements that are there which will increase the probability of repayment and decrease the probability of default. We call them as credit enhancement. So this particular issue, who has issued it, what are the collaterals that are offered along with it, are there any kind of credit enhancements to that particular issue, and what are the different kinds of covenants that are packaged into it. A detailed understanding of each of these structures need to be understood, and that is where the final assessment of the worthiness of that particular bond is evaluated. So we'll go one by one in terms of understanding each of these dimensions, right? Now, from an issuing company's perspective or issuing entity's perspective, I need to look at what is the legal structure. Is it issued by the government? Generally, what we see is the sovereign kind of bonds. They are more issued by the government. Or is it issued by the corporation? And especially when I am talking about corporation, I need to be even more clear in terms of, is it issued by a subsidiary of the corporation or the corporation itself, or even the holding company of that particular firm can issue. So who is the actual legal entity who is issuing? Is it the subsidiary? Is it the corporation? Or is it the parent of this particular corporation which is holding a few other firms as well? Who is issuing? Because each of them may have a different quality, credit quality. Each of them may have a different credit quality. So the probability of default may differ for each one of them. So a good understanding of that is very much required. And in some cases, what could happen, especially what is happening nowadays, is an SPV, special purpose vehicle, or a special purpose entity, or a special purpose company. There are different names. Special purpose entity, special purpose company, all mean one and the same. It's like, okay, if this particular company wants to raise capital for some specific purpose, issue bond. Instead of this company issuing the bond on its own, it is transferring some, it is creating one new legal entity which is called as the special purpose vehicle, and this, it is transferring a few assets to this legal entity, and this legal entity is a private entity which is issuing the bonds and raising the capital. And these assets are typically the ones that are securing this bond issue. So a special purpose entity or a vehicle is primarily created by purchasing some of the assets of the original company, and that purchase is typically funded through the issue of the bond. So these kind of bonds, especially that are issued by the special purpose vehicle, are called as the securitized bond. And here, because there is a claim on these particular assets, the whole thing is collateralized by these assets which are transferred from the original company to the SPV. There is some kind of securitization to the investor. In case this company default, these assets are being used to back the payments that are associated for these bondholders. So the risk is typically considered to be lower, and they are typically called as bankruptcy free kind of entities as well, because there are assets which are backing these payments. So generally they are more and more bankruptcy free, bankruptcy remote kind of vehicles, and these assets that are owned, they are used for making the payment to the bondholders. Even if the cash flows are not sufficient enough to repay these assets which are existing, they would be sufficient to typically repay the principal as well as the interest payments. So we really need to understand who is the entity. Is it the government, or is it a corporation, or its subsidiary, or its holding company, or is it issued through a special purpose vehicle? So this one dimension needs to be comfortably understood. And along with that, I also need to understand how is it repaying. Each of them will typically repay in a different way. Probably if I am looking at a special purpose vehicle, see, this capital is typically being raised, the assets are being used, and what we typically see is whatever these financial assets that are there, what are the kind of cash flows that these different assets are generating. And these cash flows which these different assets are generating are used to typically pay to the bond. Whereas when we talk about a sovereign bond, probably the government pays the bond investors through the taxes that they are collecting. So any government related, it might do the repayment of both interest as well as principal through the taxes. Whereas when we look at any from a corporation's perspective, this particular capital through the bond issue will be used for different operations, and whatever is the cash flow that is generated from the operations will be used to make the payments for interest as well as the principal, right? Then I also need to look at the collateral dimension, something that is used or pledged by the company to support the bond, to make the payments in case the company defaults on that bond. That is what we are calling as a collateral. So those kind of bonds for which some assets are pledged as a security against the default on the bond, those kind of bonds are called collateralized bonds or secured bonds. So specific assets would be set aside. The company would be specifying which assets would be used as a collateral, which means from a lender's perspective, the probability of default is getting reduced, because even if the default occurs, these assets will be used as a backup. These assets would be sold, and from the proceeds of that, the payment would typically be made. But in case we are talking about unsecured bonds, first of all, there is no specific asset that is set aside to make the payments. So overall assets and cash flows are the ones which the bondholders would be having an access to. So whatever is the residual, they would be receiving that portion of the residual. So the more and more the secured they are, the lesser is the credit risk associated with them, right? So with respect to them, any secured bond, it is having the highest priority in case the company is winding up. In case the company has gone bankrupt or it is liquidating, this set of bond investors, they would be having the highest priority on the claim, right? Whereas the next in line, wherein we are talking about these are typically called as the senior debt, senior secured. Whereas on the other side, I can have senior unsecured bond, which would be the next in priority, or probably I can even call it as one more subordinated, which have even more next in priority, typically called as a junior debt. So for the different kinds of secured and unsecured, depending on the assets that are typically pledged as a collateral versus the assets that are not pledged, the seniority in terms of the payment typically changes. So the risk that is taken by the senior or senior secured bonds is much lesser compared to the risk associated with the senior unsecured or senior or junior subordinated kind of debt. And on the other side, we could also see the collaterals. There is a different classification, especially the type. In some cases, the equipment can be kept as a collateral. The machines, the equipment could be kept as a collateral, wherein we call those kind of bonds as equipment trust certificates. In some cases, there could be some financial assets that could be kept as a collateral, the stocks, bonds which the company owns. They can be kept as a collateral. In that case, we call them as collateral trust bonds. The bonds are stocks that are being kept. So again, in some cases, the mortgages or pool of mortgages can be kept as a collateral. Mortgage or a pool of mortgages can be kept as a collateral, in which case they are typically called as mortgage-backed securities. Or in some other cases, there could be any other assets, probably some other loans can be kept as a collateral. That is where we call them as asset-backed securities. So there is some kind of collateralization. When I'm talking about a collateral, something is being set aside towards the payment in case there is a default that is occurring on that bond. And in some cases, we can even talk about the issue of what is called as a covered bonds. They are more and more similar to that of asset-backed securities or mortgage-backed securities, but the only difference is SPV is not created in those cases. They remain on the balance sheet of the company itself. But there is a special legal regulation that comes into picture, special legislation which makes sure that in case whatever the assets that are set aside towards as a collateral for this payment, if these assets are non-performing, the legislation says the company has to replace these assets with some other assets at regular intervals. It has to evaluate the performance of each of these assets, and in case any of these assets are not performing, then obviously these assets need to be replaced by some other performing assets, which means the intention overall is the payment to the investor cannot be delayed or defaulted. So the promised payment, both in form of interest as well as the principal, is done. So there is a full coverage of the assets at all times to make the payment to the bond investors. So understanding of what is the collateral, to what is the kind of seniority that is associated with this particular debt will really bring about a good understanding of the risk associated with this with a particular bond which is being invested. Then the next dimension that we are looking at is the credit enhancements. Okay, there is a collateral, agreed, but apart from the collateral, are there any other enhancements that will improve the probability of payment and decrease the probability of default? Are there anything additional that are coming from that dimension? And this is where we talk about both internal credit enhancements, which are built into the bond issue as a part of the indenture, and there are some kind of external credit enhancements. So when I'm talking about internal, a few of the things that come into picture: over collateralization. Talking about the collateral's value, the collateral, whatever the asset that has been kept as a collateral, the collateral's value is greater than the par value of the debt. So there is the collateral's value is more than. So if I have taken a loan for 10 million, I'm giving a 15 million worth collateral. I'm keeping 15 million worth asset as a collateral. So any fall in the value of the collateral, even if the market value of the collateral goes to 12 million also, the company may not default because it has to pay only 10 million and it can't sacrifice a 12 million asset by defaulting on the 10 million loan. So it is very much assured, it is very much looked at that the collateralization is done in such a way that the value of the collateral is much higher than the par value of the debt that is issued. And similarly, there is another way, excess spread. Excess spread, the spread itself is the difference in the yields or the interest rates. So whichever is the asset, especially with the financial assets, whichever is the asset that is kept as a collateral, which is supporting the payment, it is looked at that the yield or the return on that particular asset should be greater than the return or the yield that is typically promised on the bond, so that the interest payments are done quite comfortably. So if at all the return on the bond is going lesser than which is anticipated, even if the return on this typically falls, it would be sufficient to pay back, because overall this return is much higher than the return that typically needs to be paid towards the payment of the bond. And in case in reality the value did not fall, in case this value did not fall, again this can be used towards the principal repayment itself. But at least there is a security that is assured that in case there is a default, there is some kind of protection towards the payment for the bond investors. Then one more dimension that is being typically looked at is tranching. Instead of, see, let's say we are talking about a securitized bond. If I'm talking about a mortgage backed security, so the underlying asset is a pool of mortgage loans, right? So the borrowers typically would be making the interest and the principal repayment, and this depending on when the borrowers are making the interest and principal repayment, the bond investors who have purchased the bonds of this investor, when this borrower has repaid the interest, these guys would be receiving the interest. When the borrower has repaid the principal, these investors would be receiving the principal. But here there could be a difference. Now different borrowers may be having different credit ratings, and so from that perspective it should not happen that all these investors are carrying the same amount of risk. So depending on the cash flows that need to be paid, typically all these payments are divided into tranches. And this tranching is done in such a way that for this group of investors, the interest and the principal payment is done on a very high priority. So the first payments typically happen to this group. The whatever is left, the next payments go to this group and finally to this group, which means this group of investors will receive the last, which means they are more and more subordinated in nature. Their the risk of default is very high for them, whereas here it is moderate, because the payment to these parties will be defaulted only after the entire amount is defaulted for this group. Whereas for this group, it's very rare that they will not receive the payments, because that can happen only if the company has defaulted on this group as well as this group completely. Only then the risk comes out or the impact comes out for this particular group, which means they are having a seniority in terms of claims. This whole payment is repackaged in this way, and that is what we are calling as tranching. So these are the ones that are the least seniority kind of a debt, and they have the highest risk. they face the probability of default to the highest, then the next, then the next. And that's the reason this kind of payments typically call as waterfall structure, because the senior debt receives the payments on a top priority, then comes the one that is next in the subordination layer, and finally the most junior, the junior most subordinated debt is typically going to get the payments towards the last. So these are the different kinds of internal credit enhancements that we can look at. And along with that, there could be a few external credit enhancements as well. Means they are not packaged as a part of the bond issue, but the company is doing, but the issuer is doing some other kinds of tie-ups, so that the bond investor is compensated in case of a default. And few of them more go like, there is a surety bonds. Surety bonds can be typically purchased from the insurance companies, and it's a kind of an assurance that in case the company defaults, in case the issuer defaults, the insurer is going to make up for the loss. So bond investor does not have much of a worry there. So the issuer can typically have a surety bond assured by the insurance company by paying some amount of a premium. In case of a default, the payout would be done. Similarly, the banks can get into that kind of a model through what is called as bank guarantees. If an insurance company gets into that kind of assured payment in case of a default, that is happening through a surety bond. If a bank is getting into it, then we are talking about as a bank guarantee. Then we also have a letter of credit. It's a kind of a promise from a bank. It's a kind of a promise from a bank to typically lend. It will give a loan to a company in case it is falling short of cash, which means the company can use that loan amount to typically make the payment in case there is a shortage of cash. But if we see all these kinds of enhancements, they are typically going to increase the credit quality, decrease the credit risk to the investors, and they improve the ratings of that particular issue. But the only drawback is the one who has guaranteed, probably insurance company in this case, the bank in this case, if their quality worsens, then even the credit quality for these kind of bonds which are issued and enhanced through external credit enhancements, even their ratings and their credibility also falls significantly. So that's one other important dimension, which means from a bonds perspective, not just the collateral, any other additional credit enhancements present, that is definitely going to help out in terms of reducing the overall credit risk, right? So those are the different legal and regulatory dimensions. But one more dimension that is worth looking at is from the tax perspective. And a simple way to look at the tax is whatever the regular coupon payments that are coming out, there is a kind of it's treated in the form of interest, and because of that it goes as a part of the normal taxable income itself. Just like the way the salary is taxed, even the interest payment is also taxed in the same way. And in some cases, especially if they are with government kind, if they are government securities, whatever the interest, there could be some kind of exemptions for some kind of bond. Even the interest that is received is exempted from income tax as well. But when we are talking of selling before maturity, when we are talking about the selling of the bond before the maturity, we are typically looking at the capital gain or loss. The capital gain or loss, again there is a different taxation, the capital gain tax, which would be not be the same as the interest and the typical income tax. what we see in majority of the companies is this capital gain tax, especially when the company has, especially when the bond is sold at a price which is higher than the purchase price. We are calling it as a capital gain, and the tax rate is generally lower for a capital gain compared to the income tax. But again, if it is a long-term capital gain, the sell-off has happened after a specific minimum period. It is treated as a long-term capital gain, and in some countries there is no long-term capital gain tax at all, whereas in some other countries it could be very, very low as well. So that's one more dimension that we need to understand from a tax perspective. And in general, any kind of discount bond or pure discount bonds, especially where we are seeing zero coupon. No coupon is paid and only the par value is paid on maturity. So they are issued at a discount to the par value, right? That's the reason they are also called as OID bonds, original issue discount kind of bonds. In these kind of bonds, see whatever the increment in the value that is coming year over year, that's actually the interest that is accumulated or accrued. So the interest is applicable, though they are not getting paid. The interest is actually accrued, which means the interest is treated as a part of the taxable income, and the income tax has to be paid on the top of that. So it is coming out in such a way that though the person is not receiving any cash flows intermediately, but because the increase in the value is treated not as a capital gain but as an interest that is accrued, it is treated as a tax and the person ends up paying tax, which means for a zero coupon bond, the tax is applied much, much before receiving the cash flow itself. This is one important dimension that needs to be considered, and that is where a good understanding of the differentiation between the capital gain and the interest based income tax need to be looked at. So these are some of the important legal, regulatory and tax considerations with respect to fixed income securities. A lot and lots and lots of clarity need to be developed on these things before going forward in terms of investing or recommending these investments to your various clients and investors, right? Now let's look at the different kinds of bonds and how the cash flow structure changes for each of those kinds of bonds. So, in general, for any kind of a bond, a very common kind of a bond structure is the bullet bond structure, right? And in this bullet bond, we see that the coupons are being paid at regular intervals over the entire life of the bond, which means a typical bullet bond can talk about a semi-annual coupon payment, and to a large extent that coupon that is paid could be fixed. And on the final date, which is the maturity date of that particular bond, there could be a principal that is repaid along with the final coupon, and that entire thing that is repaid on the maturity date, which includes the principal along with the final coupon, is what we call as a balloon payment. So which means in a typical bullet payment structure, the coupons are paid at regular intervals of time, and on the maturity date, the coupon along with the lump sum principal amount is being repaid. Until the maturity date, the outstanding principal remains the same. It does not decrease. Only the interest payment, only the coupon payment is being paid at regular intervals, and the principal is not even touched until the maturity date. That's a typical bullet payment structure which is associated with a good number of bonds. Whereas on the other side, We can even see a bond which is following an amortizing loan kind of a structure. When I talk about an amortizing loan, yes, even in this kind of a bond, the regular coupons are being paid, but along with the coupon, some amount of principal repayment is also being done at regular intervals. So it's just not the coupon or the interest that is being paid. Along with that, a portion of the principal also might be repaid. Those kind of bonds where some amount of principal repayment also occurs along with the interest, they are called as amortizing loans. And what we typically see is these amortizing loans, some of them may be fully amortizing and some of them may be partly amortizing. And whenever I talk about a fully amortizing loan, it works out that all the principal is repaid before the maturity date itself, which means just when the maturity date arrives, just when the maturity date reaches, the outstanding principal is becoming zero. Whereas in case of a bullet structure, we are seeing that the outstanding principal is the entire principal amount at the maturity date. In case of fully amortizing, the complete loan is paid off by the maturity date. Typically, the home loans, the automobile loans, they are all following such a kind of a structure. And what we see is the outstanding principal keeps reducing for each period because there is a portion of a principal that is repaid at the end of each period along with the coupon payment. Whereas there could be some other kinds of structures which are partially amortizing, which means the entire principal is not repaid before the maturity date. Probably a portion of the principal is repaid, which means on the maturity date, instead of the full principal amount, a part principal amount needs to be paid like a balloon structure, like a lump sum, but the remaining portion of the principal might have been paid during the life of the bond. Along with the coupons, a portion of the principal would have been repaid, but not the entire principal amount. Those kind of structures are called as partly amortizing kind of structures. Then a bond can also have a sinking fund provision. In a sinking fund provision, as the word itself is saying, the principal amount keeps sinking down. So the principal is repaid through a series of payments. Instead of repaying the principal at one go on maturity like a bullet structure, or instead of gradually changing the principal amount like an amortizing role, here the principal is repaid as per some percentage, as per a predetermined amount. The principal is repaid through a series of payments. So it's not done entirely. Probably it can say 10% of the principal would be repaid every year. Right, so those kind of structures are called as sinking fund provision structure. The overall principal is repaid as some percentage every year instead of retiring all of them on the maturity date. And of course, different sinking fund provisions can have different kinds of features. In some cases, there may be a provision which says there might be a few years where no redemption is done, no principal is repaid, or there might be a possibility where the sinking fund can either increase every year or the percentage of the amount that is retired every year can decrease with time or can increase with time. So how much amount is really synced? how much amount is really being bought back, how much worth of bonds are typically being bought back, how much of principal is being repaid. All these things can vary for different kinds of sinking fund structures. In some cases, there might be a possibility of accelerated sinking fund, which means there is an option that will be available to the issuer that if he really wants, he can, or if the company really wants, if the issuing company really wants, the company can pay back more principal amount than what is initially specified. That is what is the accelerated sinking fund. Or there could be a more specific one like a doubling option. This is also one more option that could be available with the issuing company, and that option could be if the issuing company is interested, or if the at the option of the issuing company, it can very well double the amount of principal repayment in that particular year. So a sinking fund provision, whereas the original definition is a portion of the principal is repaid every year as per a predetermined understanding, which is mentioned as a part of the bond indenture, there might be some kind of modifications or options that could be built into them. In some cases, these kind of options really benefit the issuer in a very heavy manner, and sometimes they may be benefiting the investor as well. And just on the other side, these sinking funds, the retiring of these various bonds or repayment could be done generally at a par value, or in some cases it could very well be done at the market price, especially if the market price is much lesser than the par value. Right? And when will the market price be lesser than the par value? Especially when the interest rates in the market have gone up. When the market rates go up, the bond would be traded below the par, because there is an inverse relationship that is existing between the interest rates and the price of the bond. So in some cases, the issuer can really buy back the bonds or retire the bonds at below the par market rate, below the par rate itself, when the market price is much lesser than the par value. So in some cases we see that the sinking fund structures are advantageous to the investors. When are they really advantageous? See, if from one side I could simply see that a portion of the principal is getting repaid every year, which means the amount that is outstanding on the maturity date is actually going low, because a portion of it is really paid in the middle itself. So the amount that is typically at risk by the maturity date is actually going down. So the credit risk is getting reduced, and that's an advantage to the investor. But if I start looking at it from the other side, yes, there is a portion of the principal that is received earlier. But what if the interest rates in the market are much lesser? At that time when I have received, what if the interest rates in the market are much lesser? That is where the investor is exposed to a reinvestment risk. He is not able to invest that intermediate proceed at an attractive interest rate. So especially when the interest rates in the market are much lesser, when the principal is received, that is where it is disadvantageous to the investor. And and especially when the interest rates are much lesser, there is an inverse relationship right? I mean, we always talk about an inverse relationship between the interest rates and the price of the bond. So when the interest rates in the market go lesser, it is generally observed that the bond will be sold at a premium. And when the bond is sold at a premium, but based on the sinking fund provision, the company can buy back the bond at a lesser price itself. So the investors may not be willing to surrender their bonds voluntarily in case the interest rates are lesser and the market price of the bonds are much higher than the par value. In that case, generally the trustees will try to identify those particular bonds on a random basis. Those particular bonds that need to be retired, they are typically identified by the trustees of the bond on a random basis. Now, if my bonds come at random, which means I have to receive that predetermined amount which may be much lesser than the current market price, which means I have to surrender my bonds forcibly at a much lesser price compared to the market price. So that's one more disadvantage that can come out with this sinking fund structure. So, but what we could see is in some cases it can create advantages to the investor, whereas in some cases it could be completely disadvantageous to the investor. Then, one more dimension to look at is, see, the coupon rates need not be fixed. While a good number of bonds have the coupon rates as fixed, there might be equally good number of bonds where the coupon rates can be floating itself. So wherever we are seeing that the coupon rates are not fixed, we call them as floating rate notes or floaters. So the general characteristic of the floating rate notes is the interest is completely based on the market rates, right? The coupon that is paid could be completely based on the market rates. There is a reference rate that is typically determined. It could be the reference rate could be LIBOR, or the reference rate could be the lending rate in the domestic country, or it could be the home loan rate in a particular country. Any of these things could be taken as a reference, and if required, some kind of a margin in terms of the basis points can be applied on the top of the reference rate based on the credit risk that is associated with the borrower. So I can very well say that this particular bond will pay a coupon which is equivalent to LIBOR plus 100 basis points, which means the coupon that would be paid is based on the LIBOR which is prevailing at that particular point in time, and 100 basis points, which is 1%, right? 100 basis points is 1%. 1 basis point is 0.01%. So LIBOR plus 1% interest rate is typically being paid as a coupon. So as the LIBOR changes, even the coupon that is paid on that particular bond also changes. Now here, one more important point that we need to understand is whatever is the interest, that is prevailing at the beginning of the period, right? Whether it is an year or quarter or whatever is the interest that is prevailing at the beginning of the period, I see that the payment, that amount or that interest is used for the payment at the end of the period. Now let's say we are talking about a semi-annual payment, right? We talk about let's say a semi-annual payment, and which means I have a payment on 1st Jan and I have a payment on 1st July. Let's say the LIBOR on 1st January is 5%, and I am adding a margin of 1%. So the 6% is the interest rate as on 1st January. Now in any floating rate payment, whatever is the principal, let's say $100 million is the principal. Now the interest that is applicable is 6 million. Now this 6 million is the typical payment that happens on 1st July, not on 1st January. Whatever the interest that is decided at the beginning of the period is typically used to compute the payment that is done at the end of the period. And the frequency of the payments can very well vary. In some cases they could be a quarterly payment, some cases annual payments, but whatever it is, whatever is the period, the interest rate that is applicable that is determined at the beginning of the period is typically used to compute the payment that is to be done at the end of the period. And in some cases there could be a variable note itself. Variable rate note is this margin, whatever we are talking of, 1% excess margin above the reference rate. This margin itself could change. See, generally in a regular floating rate note, this reference rate will keep changing. So depending on the LIBOR, this reference rate changes, and I can say 1% above the reference rate or 100 basis points above the reference rate. But when I am talking about the variable rate note, even this margin above the reference rate, even that could change, which means that's one more kind of an instrument. Similarly, there could be a few instruments which are classified as caps and floors. So yes, floating rate note, a simple meaning is whatever is the market rate plus some kind of margin. That is what we are calling as the coupon that needs to be paid. But what we are saying is this can go, see, if the market rate is 8% and let's say the margin is 1%, the coupon that needs to be paid is 9. If the market rate goes to 10%, the coupon that needs to be paid is 11. So there is no upper limit with respect to the coupon that needs to be paid. But when a cap is being looked at, it is the maximum limit. Yes, even if the market rate goes to 12%, the maximum coupon that would be paid is only 10. So as long as the market rate is less than, let's say, 9%, the coupon that needs to be paid is the market rate plus the margin. But the moment that the market rate crosses 9%, we'll say that the coupon that would be paid is 10% only. It does not follow the process of market rate plus margin. That is the cap, which would always benefit the borrower because the upper side of the coupon that needs to be paid is typically getting capped. Similarly, when we are talking about a cap on the lower side, we are calling it as a floor. Okay, as long as the market rate is greater than 5%, we can talk about the market rate plus margin. But if the market rate goes to below 5%, we'll say a fixed 6%. We don't go with market rate plus margin. We say that a minimum of 6% needs to be paid, which means this is a benefit to the investor or the bond holder because there is a minimum guaranteed return that the investor is receiving in this particular case. So any instrument, any bond could be packaged along with a cap and floor also. Then we are also talking about some kind of floating rate instruments which are classified as inverse floaters. Any normal floating rate, it is linked with the market rate, which is a reference rate plus some kind of a margin. So if the reference rate increases, we see that the coupon rate also increases. This is a normal floater. But when I am saying inverse floater, The coupon rate is inversely related to the reference rate. So as the reference rate increases, the coupon rate decreases and vice versa. So even those kind of instruments are very much available, which means what we could see is while a typical fixed income security is focusing more on fixed coupon payments every period, we are also seeing equally good number of variants as a part of the floating rate notes where the coupon could be paid on a completely variable basis along with some kind of caps and floors, or even the inverse kind of floating instruments can be issued on the top of them, right? And now a few other very important coupon structures that we can look at. One, the step up coupon. As the word itself is saying, the coupon will increase with time. So in the initial periods, a small coupon amount is being paid, but gradually the coupon amount can typically increase. So generally issued by the companies wherein in the initial years they are expecting very low cash flows, very low amount of cash flows coming, in which they may not be in a position to pay the interest. So they think of issuing such kind, and that coupon at what time periods, what is the kind of increase that can come to this coupon is predetermined itself. It is mentioned as a part of the indenture itself. So this kind of instrument can be issued by the company, and at any point in time, especially when the step ups are happening, let's say it can say after first year there could be a step up, then the next step up could be after 3 years or after 7 years or after 10 years. So during the 7 and 10 year period, the coupon is going to be the same. Then again during 3 to 7 years, the coupon is going to be the same. Such a kind of coupon payment structure could be bundled. But along with that, there could be a call facility that is offered to the issuer. If at all, the company wants to buy back the bond at a predetermined price, the call option always gives a predetermined price itself. So if the company wants to call back or buy back the bond at a predetermined price, it can very well do it at every step up date. The reason is if the new coupon generally is higher, and because the new coupon is higher, what we typically see is the bond goes into a premium. The value of the bond increases because the coupon that is going to be paid in the future is going to be higher. So the value of the bond typically goes up. So the bond becomes a premium bond. So this is where the company can really buy back the bond at a older price, at a lesser price, and reissue them into the market, right? Because the buying back can be done at a specified predetermined price, which might be lower in some cases compared to the market rate at that point in time. So if at all, generally what we see is if the new coupon, whatever is coming up at the time of step up, if it is greater than the yield to maturity of the bond on that particular date, we see that the company will definitely call back the bond and reissue it at a lesser price. But from the other side, if I look at, if the quality of the bond is deteriorating, if the credit quality of the bond is deteriorating, obviously the interest rate, the coupon rate should typically go up. And generally, this would be an advantage for the issuer, especially if the credit quality is deteriorating. Because if the credit quality is deteriorating, the only way to remain competitive is increase the coupon rate. But the basic structure of the instrument is the coupon rate has gone up. It may or may not be because of the credit quality decrease, but because it has gone up, the investor feels that he is protected against the deterioration of the credit quality of this particular company. So that could create some kind of an advantage. And even if the market rates are going up, logically the coupon also should go up. So even investor would typically feel better off. Even in terms of market rate, the coupon is not a lesser amount, he is receiving a higher amount itself along as the coupon rates are increasing. So that's even a kind of a positive confidence booster for the investor. So some kind of clear cut advantages visible with respect to step up coupons. Similarly, we can talk about another kind of a coupon structure, which is a credit linked, which means if the credit quality worsens, the coupon will increase, and if the credit quality improves, the coupon will decrease. So this kind of a packaging could be there with respect to the coupon. But yes, this is fine. If the quality is improving, the coupon rate is decreasing, fair enough. This is beneficial to the issuer. Even investor may not feel too bad about it. But this is an area of concern. If the credit quality is deteriorated, then the coupon has to go up. And if the coupon has to go up, there is a pressure on the company. Why did the credit quality degrade for this company? Because its paying potential has gone down. And during that period, it is now it is having an additional pressure that it has to pay some more coupon, which makes its situation even more worse and goes into a kind of a contagious effect. It's a cyclical, right? Because now the quality has gone down because its paying capacity has gone down. So during that time, this credit linked coupon is saying the coupon has to go up. Where can the company pay that additional coupon amount from? It will create the situation even more worse. So that is where the probability of default can go up drastically, and that is where the credit linked coupon instruments, they are not that highly advisable. Then the third kind of coupon structure that I can look at is PIK bonds, or payment in kind of bonds. Especially instead of paying the coupon, the principal outstanding is actually increased. So the principal keeps growing year over year, but the coupon payment is happening at a much lesser amount, and in some cases the coupon may not be paid. Again, this is a kind of a situation that would be beneficial to those firms which are not expecting heavy cash flows in the initial years, but they may expect some better things to happen at a later date. So especially for those firms which are having shortage of cash flows in the beginning, or the firms which are using high leverage, if they have to use high leverage, the debt is higher compared to the equity. So the interest payment would be drastically higher. If the interest is much higher and the cash flows are much lower, the quality is going to go much worse. So that is where they can try to repackage the stuff by trying to increase the principal outstanding rather than paying the coupons at regular intervals. So those kind of companies whose credit quality is going down because of the shortage in the cash flows or because of the usage of high leverage, these kind of coupon structures may really come out as a saving grace for them. And there could be some other instruments where the coupon could be deferred or split. So in these kind of instruments, the coupon is deferred, which means right now, let's say if the bond is issued, instead of coupons in a normal kind of a bond, the coupons are paid, let's say, every 6 months. Now in a deferred coupon, at least a first few initial coupons are not paid. The first coupon payment will commence only after a specified period of time. Again, this is more and more suitable to those companies which do not receive cash flows in the initial few periods, and the real cash flow commences only after a certain point in time. Especially large infrastructure kind of projects, they don't receive, they have a very long building period or a construction period. So by the time they generate the first revenue and by the time they generate some cash flows, it takes a few periods. So in those kind of cases, the coupons can be deferred, and the higher coupons could be paid at a later date. So that is one more kind of instrument that are available. And probably when we look at a zero coupon bond, where no coupons are paid in the initial years and only a maturity is the principal is paid on maturity, I can very well visualize that also as a special case of a zero coupon bond. So a special case of a deferred coupon bond. So all these are different examples of different coupon structures. Then we can have a few bonds which are completely index linked. Means the coupon as well as the principal repayment are linked to some kind of an index. Some of them are linked to an inflation index like a CPI or consumer price inflation or a wholesale price inflation index. So they are linked to some kind of an index or equity index, or even some kind of commodity index, some kind of a published index, bond index, some kind of published index. So depending on the changes that have come out as a part of that published index, if it has gone up, the coupon will go up by that extent, the principal will go up by that extent, and vice versa. So if there is an increase in the index, even the coupon and the principal can go up. If there is a decrease in the index, the coupon and the principal payments could go down. That's a very simple plain vanilla style. But there could be a few instruments where principal can be protected as well, which means if the index is up, the coupon and the principal payments can go up. But if the index is down, at least the principal payment will remain flat, it will not go down. Which means there is no way a loss can come on the principal repayment in these kind of securities. The index linked securities which have a protection of the principal linked with them. And we could see a few more variants of these index linked ones. One, there is an indexed annuity kind of a coupon structure, wherein all the payments, they are amortized fully, but the payments are completely linked with inflation. So the interest and the principal payments keep changing. The composition of the interest and the principal repayments keep changing along with the inflation. Whereas on some cases there could be an indexed zero coupon bond wherein the maturity amount is adjusted for inflation. So if the inflation is higher, the maturity amount will go up. Inflation is lower, the maturity amount will go down. So those are the indexed zero coupon bonds. In some cases, the companies can issue interest indexed bonds. Only the interest part is indexed, not the principal part. Interest part is index means the coupon will change along with inflation. If the inflation is more, the coupon that is paid during that period will be much higher. If the inflation is down, the coupon that is received during that period will go down. But the principal is remaining fixed. Whereas on the other side, we talk about a capital indexed coupon structure wherein the coupon percentage is fixed. So the coupon does not change with inflation, but it's only the principal amount that typically goes up or down. So the principal is increased with inflation, but yes, the coupon percentage is fixed, which means even if the principal earlier was 1000, now because of inflation the principal could become 1020, but the coupon rate could still be 5% only in both the cases, which means here I could see whatever was the coupon earlier of 5, now I could visualize that the coupon is going to be 5.1. So the coupon also varies accordingly with inflation, though we could see that the percentage is fixed. So the capital indexed bonds are the most common ones, though it is specified that the coupon rate does not change. The actual coupon that is either received is increasing or decreasing with the inflation. So the coupon is computed based on the new principal with the same older percentage. So it can either go up or go down with the inflation. So which means the purchasing power does not change for an inflation capital indexed bond. Very commonly used, very commonly issued kind of securities, otherwise called as TIPS, if they are issued by the government, treasury, inflation protected securities. So they are completely a protection against the inflation because both the principal is protected as well as the coupons are protected. Then we could also see another kind of instruments called the equity linked notes, wherein probably they have lots and lots of features of equity rather than that of a bond, because no regular coupon payments, right? But the final principal is completely linked up with some equity index. So if the index value has gone up, the payment here goes up. If the equity index goes down, the payment of the principal will typically go down. So no coupons. They are generally traded like equity instruments, and they need not be protected because the equity value, they are not principal protected in general, because the equity value could either go up or go down during a particular period. So they have almost all the characteristics of the equity itself, but without purchasing the ownership of that particular underlying stock or an index. So these are different kinds of fixed income securities that are there prevailing in the market. Many more variants are there. But what we could see is the cash flows associated with each of these different kinds of instruments is differing. So depending on the requirement, a specific kind of cash flow structure is being chosen. So understanding of these various cash flow structures is very much essential from any analyst's perspective. All right. Now let's look at a few contingency provisions on the bond. Typically, whenever we talk about the contingency provisions, we are bringing out the embedded options. Different kinds of options that are packaged along with the bond, which in some cases gives some kind of benefit to the issuer, and in some cases they give some kind of benefit to the investor or the bondholder. So they are embedded, they are packaged, they are not sold separately, they don't exist separately, and any kind of contingency event occurring, the action on those particular provisions is initiated. So there are a few such kind of provisions that could be there on the bond. So we can look at each one of them. So initially starting off with any bond having a call option packaged into it. There is a bond with a call option packaged into it, typically called as callable bonds also. Those kind of bonds which have call option packaged into them, they are also called as callable bonds. These callable bonds, they give the right to the issuer to buy back the bond, to redeem the bond at a specified predetermined price. They give an option to redeem the bond or call back the bond at a predetermined price, and probably that could very well be uh, specified at the time of the issue itself, along with the price and the date on which the callability can exist. There could be a lockout period, means some X number of years before the callability can start. So let's say I'm talking about a 20-year bond that is typically issued, and the first call date is after 5 years, which means this initial 5 years is actually called as a lockout period, or sometimes people call it as a call protection period or a cushion period, which means during this period the company cannot typically call back the bond. So there is some amount of a period for which the non-callability also exists, and after that the company can typically come out with a call schedule, which it may say, okay, after 5 years the company can call back the bond at 102% of the par value. After 7 years it can call back at 101% of the par value. After 10 years it can call back at 100.5% of the par value, and after 12 years the company can call back at 100% or the par value itself. This kind of a specification where it talks about the different time periods at which the company can call back the bond, and the price at which it can typically call back. This is called as a call schedule, different time periods, and the price at which it can be called back. So this particular time period where the first call is happening is called as the first call date, and this time period where the first par call is being done, the first callback is happening at the par value at 12 years from now, from the date of issue. So that particular date is called as the first par call date, whereas this is the first call date, this is the second call date, this is the third call date. And to a large extent we see that in the initial periods the call can happen at a premium, whereas after a certain point the par call is what is going to be existing. And typically when you look at any new any new issue to be done, new bonds to be issued, see, generally look at the situation where the market rates have gone lower, and if I see that the company is still paying a higher coupon, right, the company is still paying a higher yields or a higher coupon, it is not beneficial to the company. So what it can think of, it can call back the bond at a specified price, because if the coupon is higher, market rate is lesser, the bond would be actually sold at a premium. But the callability provision on the bond helps the company to buy back the bond at a cheaper price, just a small premium or even at par. So it is able to purchase the bond back at a lesser price than the market price. So once it has bought back, it can actually do a new fresh issue at a lesser interest rate, because the current interest rates are lesser in the market. So it can very well reissue the bond at a much lesser interest rate. So it is very much advantageous to companies. They'll generally exercise this call option. They'll generally use this call option, or they'll generally exercise this callable bond when the market interest rates are lesser. When the market interest rates are lesser means it could be because of the general economic scenario itself, where the market rates have gone down, or typically if the credit quality of the company has improved. If the credit quality improves, obviously the market rate goes down, the yield will go down, which means the bond gets traded at a premium, but the company can buy it back at a pre-specified, predetermined kind of a price. So that is an option that is beneficial to the issuer, and it is a disadvantage to the bond holder, because when first of all, the bond holder does not know when he is going to get the redemption value, because he will not be holding it up to maturity. When the company wants to buy back, it can buy back the bond, which means the investor will be ending up with a value, with a redemption amount probably much before the maturity date itself. So this particular amount that is received much before the maturity, it needs to be reinvested, and obviously the market rates are lesser, and because the market rates are lesser, there is a possibility of a high reinvestment risk. It might be very much possible that the investor may not be able to invest it at the rate which he would have got if this bond has continued until the maturity. So because of that high risk, there is an expectation that this particular callable bond should offer a higher yield than a comparative non-callable bond. All else remaining the same, the yield should be higher on a callable bond compared to that of a non-callable bond. And whatever is the difference between the prices, so which means the callable bond, the price of it should be lesser compared to that of the price of non-callable bond. So that is where the yield of a callable bond is higher than the yield of the non-callable bond. And whatever is the difference between the prices and the yields of the two is what is coming out as the premium that is associated with the call option. The premium that one party is paying to the other, the issuer of the bond is paying to the investor of the bond for getting that additional right in terms of deciding on whether to call back the bond or not. And in general, what we see is these call options could be either American in nature, which means after the first call date, any time the option can be exercised. So there are so many days, any date after the first call date, the option can be exercised. Whereas if I say the European call option, it's not any date, probably only as per the schedule. Yes, 5 years, 7 years, 10 years, 12 years. That particular date on which the schedule is talking of, only on those days the European call option can be exercised. So whatever the dates at which the different prices are being mentioned, only on those dates the European call option can be exercised. Whereas in case of Bermudan, it is completely somewhere in middle of these two, because let's say this is the issue date, this is the first call date, and this is the maturity date. In case of American, almost any of these days the call option can be exercised. Whereas let's say this is the second call date, this is the third call date. In case of European, only on these 4 days the call option can be exercised. Whereas when I'm talking about a Bermudan, probably within this there are a few more periods, though not at any point. Generally, the coupon days, the coupon payment days are the days on which the callability can very well be exercised. So those are some of the things that are associated with the callable bond. One interesting part with respect to the call option is sometimes when the interest rates are higher, when the interest rates are higher, the if the company, let's say, wants to call back, right, the interest rate, see, generally what we have seen here, when the market rates are lesser, the companies will call back the bond and they'll try to reissue the bond at a lesser rates of interest. But let's say from corporate reasons perspective, let's say they want to do some kind of an acquisition, or they are getting into some kind of corporate event wherein they want the bonds to be called back. So let's assume the scenario where the interest rates are high. When the interest rates are high, normally what we see is the present value or the price of the bond typically goes lesser. When the interest rates are higher, the price of the bond can go lesser. Now, if at all we are talking about the specified price or the call price could be greater than the market price at that point. Market price could be much lesser, especially when the interest rates are higher. So the call price could be much higher compared to that of the market price. But let's say the company wants to call back the bonds during that particular point in time. Normally, when the interest rates are higher, it might end up paying a much higher amount for the investors to typically call back, and that is where this make whole call provision comes up, where the call price, the specified call price, is not fixed. The companies can compute this call price as the present value of the future coupons that are yet to be paid. They can compute this call price every period instead of fixing the call price. They can compute this call price at every period based on the fixed present value of the future coupons that are to be yet to be paid. So if the interest rates are higher, the present value will actually go down, which means the call price will actually go down. So which also gives a mechanism for the companies to call back the bond at a lesser price, especially when the interest rates are going. And what is clearly seen is this kind of a callback will happen only on a when necessary kind of a basis, because it's a penalty to the issuer. So this kind of stuff is more and more beneficial to the investor itself, which means the company will really call back only under a very necessity kind of a situation where it has to get into some kind of a corporate event for the same. Similarly, I can look at the puttable bonds again on the same lines as the callable bond. But this time the option is with respect to the bond holder rather than the issuer. So the bond holder will have the right? It's not the issuer who is having the right. The bond holder will have the right to sell back the bond. So it's in the callable bonds, we talked about the issuer having the right to buy back. But here we are talking about the investor having the right to sell back the bond to the issuer, and the price is predetermined, which means this is more and more valuable to the bond holder, because whenever he wants to sell off the bond, he can do that at a specified price. And generally, when will he do that? Especially if the market rates are higher, right? If the market price is higher than the put price, he will not sell it. He will sell it in the market. But if the market price is lesser than the predetermined price, he will sell it at the predetermined put price itself. So when will the predetermined put price be higher than the market price? If the market interest rates are greater than the bonds specified interest rate or the yield on the bond, we see that the investor will be more interested to sell off the bond, so the put option will be exercised. So when the market price is lesser than the put price, or typically when the market rate is greater than the bond rate, what we could see is the put option will be exercised. So the interest rates are typically increased, let's say in general, or even the quality of the company has worsened, resulting in increase in the interest rates, any of these scenarios, the puttable bond can come into picture. Again, just like the way the call options are exercised, we see that the put options also have a different styles of American, European or Bermudan kind of style. So because this put option is more and more beneficial to the investor and not to the issuer, the price of the put option puttable bond is higher compared to that of an option free bond. Right? Now, one more kind of contingency that is possible with respect to bonds is the availability of convertible bonds. As the word itself is saying, the bond can be converted to what? The bond can be converted into the shares of the issuing company. So there is a predetermined number of shares. Each bond can be exchanged for a predetermined number of shares based on a conversion price. So initially a conversion price will be determined. So one share of the company can be purchased, let's say, at $20. Now the bond is having a face value of $100. So one single bond probably can be converted into 5 shares of common equity. So this is the conversion price. Based on the conversion price, the predetermined number of shares are determined. Predetermined number of shares happening for conversion are understood, and that is specified at the time of issue itself. And this is an option that is available to the bondholder. So which means the bondholder can surrender the bond and in lieu of it can take the 5 shares of the company. So whatever are the number of shares that are predetermined, the investor can convert that bond into those predetermined number of shares at that conversion price. And that's the reason, because there is a feature of bond as well as equity, because up to a certain point it remains as a bond, and after that if it is converted it has the characteristics of equity. But because the option is available to the investor, he can very well choose not to convert it. So he will only convert that bond only when he feels that he is better off with the equity rather than with the bond. So the minimum value that you can assure for a convertible bond is the non-convertible bonds value itself. Either it will be more than that, or at the worst case it will be equal to the value of the non-convertible, because the option to convert will be exercised only when the value is more than, when the stock price is much higher. Otherwise it will not be converted. So the minimum value that comes out is the value associated with the non-convertible bond itself. So we could clearly see that it is a benefit to the bondholders, and whatever is the conversion value the shareholder is going to get is the amount which is equal to the share price on the conversion date multiplied by the conversion ratio, the number of shares that he has purchased by sacrificing one bond. And we could clearly see that there is a downside protection because there is no loss below the non-convertible bonds value. So because they are more and more beneficial to the investor, the issuer can provide or offer lesser yields on those bonds, and that is one benefit that the issuer can typically look at. He can offer the bonds with a much lesser coupons, especially if the cash flows are going to be much tighter during the initial periods, especially for newer and newer companies. Cash flows are going to be lesser during the initial period. They can very well issue lesser coupons because of the potential possibility to convert into equity at a later date, which can be more and more attractive to the investors. So that is one dimension where the convertible bonds become more and more beneficial to the issuers. And because the bond can get converted into equity, the debt is getting lesser and equity is going higher, which means the overall risk and the debt equity ratio of the company are going down because of this conversion. And generally, the common thing which I need to understand, a very important dimension in general, what we see is the running yield, right? The current yield is what is the name that is given. See, if I look at the coupon divided by the price, this is called as the interest based yield. The interest yield, I can compute it as coupon divided by price, and dividend yield, when I look at, I look at it as dividend divided by the price of equity. What I clearly see is the coupon yield is to a large extent greater than the dividend yield. So people, though the equity price is higher and higher, they generally don't tend to convert, because on a regular basis they are seeing that the interest yield is higher than the dividend yield, so they prefer continuing it as a bond itself rather than converting it into equity. So that is one common thing that has been observed, and that is one of the prime reasons the companies started packaging these convertible bonds with a call provision. The moment the equity price is greater than the market price of the equity, let's say if it is greater than the conversion price, in case the person is not converting that into equity, the company will initiate a call option where it can call back the bond, which means it is more or less forcing the participants to convert it into equity in case the equity price is greater than the call price or the conversion price. So that otherwise people keep continuing it until they are forced to really convert, because the interest yields are greater than the dividend yield. So another important dimension to look at. Then we have a few instruments called as contingent convertibles, wherein the instrument is designed in such a way that the debt to equity conversion is not at the option to the bondholder. It's an automatic conversion from debt to equity based on some event, especially generally issued by the banks, especially when their equity capital requirement is falling or debt to equity ratio has gone up compared to the regulatory limits. There can be an automatic conversion of debt into equity, one to maintain the regulatory equity capital and at the same time reduce the debt to equity ratio, because the existing debt is what is getting converted into equity. So these kind of bonds are also issued by companies in some cases, especially where there are regulatory requirements in terms of meeting the minimum capital requirements. And there could be another set of contingent provisions that could be packaged with the bonds, which are called as warrants, generally clubbed with straight bonds. Other name for straight bonds is the option free bonds. So there could be some warrants which are clubbed with option free bonds, where the warrant is a separate instrument altogether. It's probably, I can look at it like warrant plus a non-convertible bond together, put together, is called as a convertible bond. That can be packaged in this way. So warrant is a separate instrument which gives a right for the person who has purchased the warrant. He can buy the shares of the company at a predetermined price during a specified time period. So that is giving a possibility of taking advantage in case the share price is increasing, in case the company is doing well. The additional returns can come out apart from the bond based return. So these two are two separate instruments. He can purchase additional shares during a specified condition being met, especially when the market rates, equity interest rates have typically gone up, and this will typically act as a kind of a sweetener, especially for the new firms, because for the new firms they cannot raise huge volume of debt, and that would become more and more expensive. And so from that perspective they can choose a debt in such a way that it is lesser, but along with that debt they can package the equity, so that in case the company does well in the future after a initial high risky period, if it is able to perform well and the equity price rises, the investors are getting much benefit out of it, because they are able to purchase the share at a much lesser price. So again, a fixed income securities or the bonds can very well be packaged with these kind of embedded things, with these kind of contingent provisions, which can again create some amount of complication, and along with that trying to fit in the needs of different kinds of investors, right?